The Federal Reserve System, or the Fed, is the central bank of the United States. Everything it does is to promote the effective operation of the US economy and protect public interest. But is that what they're really doing? Experts are constantly talking about the upcoming recession. What if I told you we're already in it? And even worse, the federal body who is supposed to protect us is making it worse, with no sign of stopping. Let's back up a bit. We know that our current situation is grim, but how did we get here? It started, like many awful things, with the appearance of COVID-19. COVID restrictions led to a scary economic situation. In the US, unemployment rose to a record high 14.7% in April of 2020. That was a sudden increase of 10.3 percentage points from the month before. With that many people out of a job, we were looking at record-breaking evictions and people going hungry, not to mention all the other economic blowbacks of high unemployment. It's not hard to see why the government decided to issue stimulus checks during this perilous time. But the result of that much cash artificially injected into the economy was rising inflation. It wasn't the biggest cause of inflation, however. The Fed responded as well to try help people keep their homes and even stimulate new lending. At one point during the pandemic, the Fed cut rates even as low as 0%. This meant people who would otherwise lose their homes were able to refinance their mortgages, and people who could not afford a home previously were able to buy one, stimulating the lagging real estate market. All of this was great at the time, but lower interest rates lead to higher inflation. At the start of 2021, inflation was only 1.4%. By the end of 2021, inflation was 7%. The last time inflation was that high? 1981, at the tail end of a recession. To combat inflation that was the result of COVID emergency measures, the Fed eventually began raising rates again. But they may have waited too long. They didn't start raising it until 2022, and that was after inflation had already hit 7%, the highest it's been in 4 decades. Now the Fed is playing catch-up, raising rates to combat the result of monetary policy during the pandemic. But the rate hikes have their own effects, especially with many banks teetering on the edge. You've probably heard about the recent huge bank crashes, and they might be making you nervous. They're making a lot of people nervous, including the surviving banks. Banks know that in this financial climate, people get scared, and when people get scared, they take out their money. If too many people do this, the bank might run out of cash to give them, and the bank will fail. To guard against this, banks are turning to the Fed as a lender of last resort. Thanks to the Fed, many banks now have more cash on hand to pay for withdrawals. But as you may have guessed, there's a catch. While this solution may work in the short term, over the long term, banks are losing money on this deal. That's because the Fed is charging higher interest rates for loans than banks are making on the money. It's like if you took out a 5% interest loan and invested it in a savings account that pays you 0.3% interest. The math just ain't mathin', as they say. It's a losing deal for the banks, which means their net worth is going down, which means they are going to lend less. Less lending by banks is another thing that slows down an economy and leads to a recession. Let's talk for a second about that scary word, recession. What does it mean, and is it always terrible? Actually, all economies go through periods of contraction, aka slowdowns. It's like anything else in life. What goes up must come down. Economies are generally thought to have 4 phases that we continually cycle through. The first phase is expansion. This is when interest rates are lower, so more people can borrow money to buy things, start businesses, and hire people, who can then spend their new income to keep the cash flowing. All of this generates high gross domestic product, or GDP, which is the economist's way of saying how much stuff people are buying. It's one usual way to measure the health of an economy. Usually, we measure this expansion by economic growth. So it's not just about having a high GDP, but about having a bigger GDP than last year. Eventually, we get to the second phase, the peak. This is the point at which the reaction of all this spending comes home to roost. Businesses try to expand, but even if they do, they don't see additional profits. Consumers have money to burn, but nowhere to put it, or inflation will make it so that their money just doesn't buy what it used to. Usually at this point, the Fed will raise interest rates to try to slow down inflation and growth. Growth isn't always good. If spending goes up too quickly, it can be a bubble. And when it bursts, you get very bad recessions, like the 2008 housing market bubble. That's why the Fed will often raise interest rates just when the economy seems to be really heating up. They want to control growth so that we don't get out of control in the next phase. Contraction. This is when inflation and other factors start to limit cash flow. People stop spending as much, especially on luxury items. This means production slows to match demand, and hiring can slow, or companies may even start laying workers off. A contraction is normal and often leads to a normal short recession. However, a contraction can lead to a more prolonged period of economic decline, and in those cases, a recession can be truly damaging for most people's lives. If the economy looks like it's headed for a severe recession, the Fed usually lowers interest rates to encourage borrowing again. After the contraction, we see the final phase, recovery. Some less optimistic people call this the trough period. This is when the economy bottoms out, hits the lowest point for this cycle, and begins to make its way back to the start of a cycle. There is no way to avoid the different phases. They are natural parts of an economic life cycle. However, the Fed and other decision makers can affect how big of a contraction we have and how long it takes to get a recovery. They can also, if they make the wrong decisions, bring about a contraction phase earlier than necessary. We're already in a contraction or recession phase now, and with how the Fed has been handling things, it's only going to get worse. What makes a contraction period a recession? Most analysts say 2 consecutive quarters or 6 months of decline in a country's GDP counts as a recession. This is usually accompanied by an increase in unemployment, a drop in the stock market, and a dip in the housing market. We have had 2 consecutive quarters of negative GDP, but many are reluctant to call it a recession because of the low unemployment rate. However, unemployment is increasing. We're just coming out of record lows. So the numbers are still low, but they are going up, which is the indicator of a recession. What will we see as a result of a recession? A big recession can affect everyone. Businesses will see decreased sales, low profit margins, and their access to capital will be reduced. We're already seeing this happen now. They will respond with layoffs, reduced hours, and even in extreme cases, business closures. This will of course affect workers. Unemployment will continue rising and people will have less money to spend, causing the recession to deepen. The thing is, dips in growth are normal, but this recession hit in the second half of 2022, just after the Fed began aggressive increases in their interest rates. The Fed responded unusually to the COVID crisis, and at the time, we can see why they thought that was the best way to go. After all, the economy had ground to a halt. It desperately needed a boost. But the Fed may have boosted too much for too long. Inflation shot up, and now the Fed is trying to correct for this inflation, which was basically caused by their record low pandemic interest rates. But this means they may have saved us from a 2020 contraction only to drive us into a deeper 2023 recession. The Fed is still trying to pull inflation back down, but as they do that, they're putting more weight on an already shaky banking system and putting the brakes on an economy that was just taking off after the pandemic. They may be trying to correct their previous mistake, but as a result, they're stifling the growth period they artificially started in the first place. And now they're driving us into a recession that wasn't coming on its own. How do we know? High inflation is not usually associated with economic slowdown. Huge inflation can sometimes be related, but it's not enough on its own to cause a recession. High interest rates mean less borrowing and less movement of capital. That's what causes a recession. The Fed usually lowers interest rates to combat periods like these, but they're not doing that. Instead, they're driving interest rates to brand new heights. Why is the Fed doing this? As we said, they may be trying to correct their previous artificial boost to the economy in 2020. But while they try to pull the economy back down to size, they're strangling the growth we could be having right now. And who knows when we'll come back out of it, because the Fed says they aren't lowering rates anytime soon. How can you protect yourself during a recession, especially with the possibility of more bank failures? We tell you how in this video.